Hi, everyone. It's Ms. Palmer here again with Unit 4, Section 2 on money, banking, and monetary policy. Today, we're going to talk about the money market, supply and demand for money. The demand for money. At any given time, people demand a certain amount of liquid assets, meaning money, for two different reasons. One, transaction demand for money. People hold money for everyday transactions. And two, asset demand for money. People hold money since it's less risky than other assets. What is the opportunity cost of holding or keeping money in your pocket or the checking account? What are you giving up? The interest you could be earning from other financial assets like stocks, bonds, and real estate. What happens to the quantity demanded of money when interest rates increase? Quantity demanded falls because individuals would prefer to have interest earning assets instead. Two, what happens to quantity demanded when interest rates decrease? Quantity demanded increases. There is no incentive to convert cash into interest earning assets. There is an inverse relationship between the interest rate, and the quantity of money demanded. Okay, here's a new diagram for you to memorize and set up. And this is the demand for money. On the vertical axis, we have nominal interest rate, otherwise known as IR, and that's a percentage rate. And then we have the quantity of money in billions of dollars in this particular case. So you have nominal interest rate on the vertical and quantity of money on the horizontal. There's an inverse relationship between interest rates and the quantity of money demanded. So of course we have negative sloping demand line for money demand line. What happens if price level increases? Then there's a rightward shift in the demand for money. Money demand shifters. You need to commit these to memory and be able to set up this model and use it. Okay, one, changes in price level will shift the demand for money. Two, changes in income will shift the demands for money. And three, changes in technology will shift the demand for money. The amount of money the public wants to hold in the form of cash will decrease if interest rates increase. Here's the supply for money coming up. We have the demand for money modeled below. The U.S. money supply is set by the Board of Governors of the Federal Reserve System. We also call them the Fed. So the money supply is stable, and it's a vertical line. The Fed is a nonpartisan government office that sets and adjusts the money supply to adjust the economy. This is called monetary policy. The Federal Reserve, it was created in 1913. The Fed's job is to regulate the banks and make sure people have faith in our financial system. Increasing the money supply. Again, we have this model with the interest rate on the vertical and the quantity of money in billions of dollars on the horizontal. You have vertical money supply, it's stable, set by the Fed, and you have the demand for money at a negative sloping demand curve line. Okay, so now the money supply has been increased by the Fed by 50 billions of dollars. So there's a rightward shift in the money supply line. Interest rates will drop. If the Fed increases the money supply, a temporary surplus of money will occur at 5% interest rate. Okay, so what happens is extrapolate 5%, you have a temporary surplus. The surplus will cause the interest rate to fall to 2%. How does this affect aggregate demand, you might ask? Increase money supply. Increase, okay, so you're going to have to memorize this flow. Increase money supply yields decrease in interest rates, yielding increase in investment, yielding increase in aggregate demand. Okay, so commit this entire diagram and verbiage to memory. So take a screenshot of this and take a look at it again. Decreasing the money supply. That would be a leftward shift from MS to MS1. If the Fed decreases the money supply, a temporary shortage of money will occur at 5% interest rate. The shortage will cause the interest rate to rise to 10%. How does this affect aggregate demand? Again, you have a flow chart down below. So decrease in money supply yields an increase in the interest rates, yielding a decrease in investment, yielding a decrease in aggregate demand. So again, take a screenshot of this diagram, take a look at it, and memorize what the chain reaction of events are. Oops, let's go back. There we go. Okay, next slide. Oops, cartoon. Okay, you can take a look at this, the Fed holding the bow and arrow. Pops the inflation balloon, hits the interest rates, end up in the rear end of the loan officers, and you get the idea. Okay, here's the practice FRQ from the 2000 AP exam. You may want to take a screenshot of this. I will put up the rubric for the answer next, and you can take a screenshot of that and try and work this out on your own. Back it into the answers. Okay, here we go. This is the diagram you're supposed to come up based on the previous FRQ. All right. Okay. Okay, fractional reserve banking. When banks hold only a small portion of deposits to cover potential withdrawals and then loans the rest of the money out, a certain amount of money on deposits that banks have to retain in the bank account in order to lend out to other people or demand deposits. So if we all went to the bank to withdraw money at the same time, what would happen? They'd run out of money. Bank run. Okay, so bank balance sheets. Demand deposits. That's money deposited in a commercial bank in a checking account. Required reserves. The percent that the banks must hold by law, the percent of those deposits. They can't lend all the money out. Excess reserves, the amount that the bank can loan out. Balance sheet, that's the record of the bank's assets, liabilities, and net worth. Are demand deposits in the bank an asset or a liability? It's a good question. Liability for the bank, an asset to the depositor. Okay, so here's a bank balance sheet example. So you have assets on the left, liabilities on the right. They're supposed to total the same amount. Total assets always equal total liabilities on the balance statement. That's why they call it a balance sheet. It balances. So they have $8,000 in loans. They keep $500 in reserves and $1,500 in treasury bonds. Okay. They have demand deposits of $5,000. Owner's equity is $5,000. Those are liabilities. It is balanced because the totals must equal. If the bank is holding no excess reserves, how much is the required reserve ratio? .1 or 10%. see, they have demand deposits of 5,000. Their reserves are 500. So that's 1% or 10 or 0.1 or 10% of the total demand deposits. That's how you determine what the reserve ratio is. Okay, the following is the simplified balance sheet for Miterra Bank in the United States. Okay, so again, this is another example of what you might encounter on the AP exam in terms of a free response question. And here's the rubric. Okay, here's another example of an FRQ. And here's the rubric. Okay, let's go back. Okay, everybody, that concludes my lecture on money, and I hope you all have a good day, and we'll see you in the next lecture. All right, everybody. Bye. Ms. Palmer signing out.